Taxpayers can save money on their taxes in 2023 by getting organized, taking advantage of every tax credit and deduction for which they are eligible, and double-checking returns for accuracy before filing. There's also not much you can do to stop interest rates from climbing or stocks from falling, either. Still, you may have more control than you realize when it comes to another financial pain point that can significantly impact your budget. New law or not, it's always a good idea to be proactive when it comes to tax planning. In short, taxpayers can't cut corners if they want to save money. Follow these expert tips on how to save money on your taxes this year to reduce your tax liability and avoid costly mistakes. 1. Gather your tax documents. Before you start the tax filing process, start by gathering any important tax documents and information. Many of these documents may be available digitally, according to Joe Berman, a certified financial planner and senior financial planning practice management consultant at a Money Advisor. Getting organized is the biggest part of the effort. Many of us have gone green in the last several years where employers are using online portals, and investment companies have gone digital where those tax forms aren't being mailed to your home address, so being very proactive and going out and gathering those things is time well spent. 2. Get organized. Beyond those standard tax documents, this year taxpayers will need to check for correspondence from the Internal Revenue Service regarding the economic impact payments and advanced child tax credit payments they may have received in 2022. 3. Know when to hire a tax professional. Once you've gotten organized and taken stock of the year, you may begin to realize your financial situation has become significantly more complex this year. While it may seem counterintuitive, spending money on a tax professional can end up saving you money in the long run if you're able to avoid penalties or mistakes that are costly to correct next year. 4. Protect yourself against identity theft. Take steps to prevent identity theft before it happens and save yourself the headache and costs that go along with tax-related identity theft. Consider setting up multi-factor authentication or an IRS identity protection PIN. In the past, the IRS would give identity theft victims a PIN number, but now that's available for anyone if you want to give yourself another layer of protection, says Jerry Ziegler, an enrolled agent and Saver Life financial coach. They used to send it out by letter, but now you can access your PIN number online as well. 5. Take advantage of tax deductions. Though deductions on charitable contributions are typically limited to those who opt to itemize deductions, taxpayers are able to deduct cash charitable contributions of up to $300 if filing single and $600 if married filing jointly in 2022. 6. Consider lesser-known tax credits. Tax credits offset taxes owed, while deductions reduce how much income is taxable, making credits particularly valuable. Review commonly overlooked tax credits, like the Earned Income Tax Credit, the Adoption Tax Credit, and the Saver's Credit. The Earned Income Tax Credit, for example, is worth up to $6,728, and families with more children are eligible for higher credit amounts. 7. Properly claim dependents. Since many tax credits and deductions rely on the number of children or dependents a taxpayer claims, it's important to properly claim each dependent. A dependent can be a child under age 18 or under age 24 if a full-time student, as well as a parent, sibling, or other relative other than a spouse who qualifies. 8. Consider itemizing deductions. Since the Tax Cuts and Jobs Act of 2017 nearly doubled the standard deduction amount, you're likely to save the most money by taking the standard deduction. But individuals in a high-tax state who own a home and made significant charitable contributions in 2022 may save more money by itemizing their deductions. 9. Contribute to your retirement. It's not too late to save money on your taxes this year by making a contribution to a qualified retirement plan and getting a deduction for your contribution. 10. Contribute to other qualified accounts. In addition to retirement contributions, review your other qualified accounts and make contributions where you're able. 11. Double-check your return for accuracy before filing. Take one final look through your tax return before you hit submit. Not only can filing a clean return keep you from experiencing IRS processing delays, but ensuring your return's accuracy can also save you money by avoiding penalties or overpayments. This year in particular, your tax situation may be more complicated than in years past. If you sold or exchanged cryptocurrency in 2022, received advanced child tax credit payments, or began working remotely from another state, ensure you've taken all the necessary steps to accurately report that information to the IRS. 12. Adjust your W-4 withholdings. If you received a tax refund this year or paid a hefty tax bill, talk with your employer about adjusting your W-4 tax withholdings. This can help you save money in the long run by boosting your tax refund or increasing your tax home pay, depending on your goals. 13. Prepare for next April. Much of the 2023 year is still ahead of us. After completing your 2022 return, consider what money moves you could be making in 2023 to make your life easier when it's time to file in April 2024. Taking actions now, like deferring income and selling investments at a loss to offset gains, could save you money next year. 14. Utilizing cash value life insurance policies. Once you have exhausted all pre-tax savings mentioned above, you might turn your attention to tax-deferred saving options. A life insurance policy designed to accumulate cash with a minimal death benefit and the allowable maximum premium can be used as a tax-favored vehicle for savings. Using life insurance as an investment vehicle can provide benefits such as tax-deferred growth within your cash value and tax-free cash withdrawals via policy loans, all without being subject to annual contribution minimums like 401(k)s and IRAs are. And perhaps most importantly for high-income earners, life insurance policies aren't subject to restrictive income thresholds. Wealth management is complicated. It takes more than finding the right tax reduction strategies for high-income earners to ensure your money is working for you in the most efficient way possible. The right financial advisor makes all the difference. If you find these informations helpful, be sure to subscribe to the channel for more informations like this one. Thanks for watching.